Terminating an employee is stressful enough, right? But getting the compliance wrong, well, that's a completely different kind of headache. Welcome to this explainer, where we're going to unpack the high-stakes reality of severing employment correctly. Today, we're focusing on presenting a high-level overview of employer obligations when severing an employment relationship. It's absolutely crucial for anyone handling payroll or HR, because avoiding costly mistakes here requires some serious precision and a real deep dive into some surprisingly complex statutory requirements. Let's quickly run through our agenda. We'll be hitting 1. Severing the employment relationship. 2. Notice and vacation pay. 3. Understanding severance pay. 4. Types of termination payments. And finally, 5. Communications and checklists. Okay, so let's kick things off with a question that sounds simple but is actually a total legal minefield. When is an employment relationship actually over? You might think it's the exact moment they pack up their desk and hand over their key card, right? But legally, it can be way harder to untangle than a bad breakup.
All right, part 1, severing the employment relationship.
So before calculating even a single final payout, we have to guarantee that the cord is legally cut. And honestly, this is the danger zone. You can take away someone's desk, sure, but if you leave them on the company health plan during a transition period, well, the Canada Revenue Agency might still legally consider them your employee. If even one of these 4 criteria is met, like having a right to be recalled, an expectation of future work, accruing registered pension benefits, or participating in all previous benefit plans, the relationship is likely still active. And that completely changes the game for all your tax withholding rules.
Moving right along to Section 2, Notice and Vacation Pay.
Once you've definitively severed that relationship, your next obligation immediately kicks in. Working notice or wages in lieu of notice. And depending on where your business operates, the rules change drastically. It's wild. A 10-year employee in Ontario needs 8 weeks of notice. But look closely, so does a 10-year employee in Alberta. But at the 5-year mark, Ontario demands 5 weeks, while Alberta and Quebec only require 4. This inconsistency across jurisdictions is exactly why you absolutely cannot use a one-size-fits-all approach. So what actually happens if you just pay out those notice weeks instead of having the employee work them? Well, federally, it's considered regular employment income, so it's subject to standard taxes. But here is a massive exception that literally always catches people off guard. In Quebec, wages in lieu of notice are legally treated as a retiring allowance. That means absolutely no Quebec pension plan contributions are required, and it gets taxed using lump sum rates instead of the standard bonus tax method. It's a completely different treatment. Next up is vacation pay. And remember, guys, this isn't free money. It is earned income. Employees are owed either 4 or 6% of their vacationable earnings, depending on how long they've been there. In places like Alberta and Ontario, that jumps up to 6% after 5 years. Because it's fully earned, this payment is always considered income from employment. That means it is fully subject to all regular statutory deductions, no matter where you are in Canada.
Which brings us to Section 3, Understanding severance pay.
Now, this is where we get to bust a massive HR myth. People casually throw around the word severance all the time to describe literally any money someone gets when they leave a job. But using that term casually, huge trap. Legally speaking, severance pay has a highly specific statutory requirement under certain laws, like the Canada Labour Code or Ontario's Employment Standards Act. It is entirely distinct from wages in lieu of notice.
So what actually triggers legal severance? Well, under the federal code, employees really just need 12 months of continuous service to qualify. Easy enough, but Ontario adds a really steep, specific qualifier. The employee needs 5 or more years of service, and the employer must either have a global payroll of at least $2.5 million or be going through a mass business closure.
All right, Section 4, Types of termination payments.
With all those core payment obligations mapped out, we need to categorize them for the tax authorities, because getting this wrong leads to massive headaches down the line. Think of it as sorting into 2 distinct buckets. In the first bucket, you have employment income. This is basically money paid for services performed, stuff like salary continuance, standard wages in lieu of notice, and vacation pay. Then, in the second bucket, we have retiring allowances. Now, despite the name, you don't actually have to retire to get one of these. They're meant to compensate for the loss of the office itself or recognize long service, which includes that statutory severance pay we just talked about. So why does sorting these into buckets matter so much? One word: deductions. Employment income requires you to withhold Canada pension plan contributions and employment insurance premiums. Retiring allowances, though, they are blissfully exempt from CPP and EI deductions.
They are strictly subject to income tax withholdings using very specific lump sum rights. The difference to the employee's bottom line and, honestly, your reporting requirements is absolutely huge. Now, if you have long-tenured employees, listen up, because there is a fascinating historical quirk in the tax code that acts almost like a loophole. Parts of retiring allowance based on years worked prior to 1996 can actually be classified as eligible. The formula allows for $2,000 for every calendar year of service before 1996, plus an extra $1,500 for certain pre-1989 years. The magic here? That eligible amount can be transferred directly in an RRSP or registered pension plan without a single cent of tax withheld at source. No tax upfront at all.
But what if the employee just says, "Hey, I want the cash"? Even if you, the employer, pay that eligible amount directly in cash, which means lump sum taxes are withheld immediately, the employee still has 60 days after the calendar year ends to shelter that money in their RRSP. Once they file their personal tax return, they can actually get those taxes refunded. And finally, Section 5, Communications and Checklists. Okay, we've handled the high-level math and the legal definitions, but the clock is officially ticking. The math might balance perfectly, but if the paperwork fails, you are still non-compliant. These 4 critical steps are absolutely mandatory to officially close the employee's file. You have to notify the CRA or Revenue Quebec regarding any garnishments. You have strict deadlines to issue a record of employment to Service Canada, and if you miss that, you're looking at instant compliance issues. You also need to update pension and benefit providers immediately, and notify workers' compensation if that applies. Look, there are literally dozens of microtasks involved in a termination, from calculating stock options to securely revoking computer access. Relying on your memory to terminate an employee is like flying a plane without a pre-flight checklist. It's just a massive, unnecessary risk. Using a customized, organization-specific checklist is your ultimate safeguard against a costly administrative failure. It's the only way to ensure your terminations are systematic, complete, and legally defensible. So I'll leave you with this final thought. Termination compliance is a zero-forgiveness environment. The rules around notice, severance, and taxation are incredibly rigid, and the penalties for making errors are severe. So take a really hard look at your internal processes today. Review those tax categories and ask yourself, is your organization's termination checklist actually foolproof, or are you just one bad exit away from a really costly audit? Thanks for joining me on this explainer today.